Today's topic is investing for beginners. So it's all the good stuff I wish I knew before I started. I have a few tips that you should keep in mind when you want to start investing. So let's talk about money and get right to it. Stay also till the end because I'm going to explain what options you have to invest in and what to consider if it comes to tax. First, have a goal for your investing. Ask yourself what you want to have more money for in the future. I need to know what I'm investing, or also saving regularly. It's a huge motivation, and it helps me to stick to a long-term plan. Because investing into the stock market, but actually want to take the money out in 2 years to buy a car, makes not a lot of sense. A possible goal might be to build wealth for an early retirement, or work towards financial freedom. For short-term goals like buying a car, put the money in a saving account instead of investing in stocks. Just want to mention that one of my goals is to reach 1,000 subscribers this year. So I would appreciate if you would just fast click on that subscribe button. Understanding what you want to invest in is also very important. You gotta know what you're doing. That might seem obvious, but oftentimes it's not. People start that, and a common mistake is investing just because it promises a lot of returns with little risk. Don't be misled by such marketing messages. Always understand what you're investing in. To educate myself about whatever I want to invest in, I read everything available. For example, before I want to invest in individual stocks, I definitely read the annual reports and look at analytic rates, how that stock performed in the past, which never leads to whatever it's going to be in the future, but you should still make sure you know a lot about it. If I want to invest in funds or ETFs, I read everything I can find about that product, for example. And just to mention, you can't just invest in one company, that's one stock, or a bundle of companies, which are the ETFs, standing for Exchanging Traded Funds. All those resources are easily accessible in a library, online. Take responsibility for the investment that you're doing. You have to be able to look at your decisions you did in the past without blaming anyone else, like a bank advisor or insurance broker that pushed the product on you. You're the one who's signing up at the end. You're the one who's deciding. The decisions I make is that because I understood the product and not because someone convinced me to it. That's their job, but your job is to know what you're doing. When you're responsible about something, that responsibility gives you power, and you don't want to give the power away to someone else. It's likely I made some mistakes in the past. I will make some more in the future. What's important is that you're going to take responsibly and to learn from those mistakes. Keep a cool head. If it's hard for you to take any risks, but it is constant ups and downs, then invest with smaller amount of money, for example, for the beginning. It's important to take calm. And if you do your research, you're going to feel better for sure, because you know what you're doing. Also, don't put all your eggs in one basket, meaning to diversify your investments. This way you're spreading your risks without necessarily reducing your returns. An important aspect of diversifying is by investing in different asset classes. Like, instead of just investing in the stock market, I also invest in real estate, crypto, and gold, and keep some cash in a saving account. That way, it's balancing itself out. If one thing goes not so good, the others are still good. But if it comes to any other big purchase, and it also fits here, new predictions are made daily. And if they're wrong, they're forgotten. And if the prediction is right, they actually celebrate it. But you're the one who has his money or her money in there. So always question the motivation behind those predictions and recommendations. For example, I never day traded before. I actually see myself as a buy and hold investor. Sure, there might be some of you who are day trading and fully believe that that's working good for you. And if you're good at it and having experience or a lot of knowledge about it, maybe it's a good way to go for you. But I feel safe and secure for now, and the last over 10 years, seeing my portfolio grow and still being able to sleep well. Maybe I'm going to have more interest in the future for day trading. If so, I'm letting you know. But also here, we're back at fully understand what you're investing in. It should not give you sleepless nights. And here one thing I mentioned at the beginning are taxes. And also keeping an eye on costs and inflation. A gain is not always a real gain. Just because your investment shows a big plus, that doesn't mean it's actually what you get in your account. There are three, let's say, enemies of my return: transaction costs, taxes, and inflation, like I mentioned. First, the transaction costs. When I buy a stock, a broker is going to charge a fee. I will compare different brokers in the future. And if you do it, you're going to look for what broker has less fee. Traditionally, banks have the most fee. That's why I'm using online brokers. I'm going to make an extra video on that. Secondly, tax. It's important to not forget those. Inform yourself how big the tax rate is in your country. I hope that plant moving in the back doesn't disturb you a lot, but I have the AC running. It's super hot today. I still want to make this video because this is a very important topic. And one thing I learned for sure: don't invest just because you think you're not paying taxes for that. That would be the wrong way. But trust me, those investments are going to pay off, even if you have to pay tax on it. Thirdly, inflation. This is less obvious than costs and taxes, but if you have $1,000 today, it might be not worth the same in about 10 years, right? Because as we saw the last few years especially, what you could buy with the same money 10 years ago is less than you can buy now with the same money. That means your money loses value over time. So if you put those $10,000 or $1,000 under your pillow or in a saving account, it's not going to get any more value. But if I'm investing it, I'm making sure my money grows. Having a long-term strategy. Over a long term, stock market trends, they do have positive returns. However, there are always fluctuations, including market crashes, which can make even the best investment temporarily less good. But that's why it's important to be patient in the long-term horizon. Don't sell on the lowest point just because you're getting anxiety, because then you're going to pay more for it. You're going to lose more when you're selling at the lowest point. So that's why you're buying when it's cheap, not you're selling. Investing involves the risk of losing money, but that doesn't always mean I'm actually losing money. It can be a paper loss. A loss I'm always only doing when I'm selling on a low point. So when I'm waiting and I'm then selling when it's at a high, when it's higher, then I win money. But that's why I diversify, to keep the balance. Even if the one stock is low, another one gains. Sure, if you could look into the future of what stock is going to be best performing, well, it would be too easy, right? But if you're as high as possible informed, you're going to make at least sure that what you're investing in have a good guess on those things. But there is no one who's like 100% sure how the world looks tomorrow. But like I said, under the pillow, your money is going to just lose value over time. Returns come from risk. The higher the potential returns, the higher the risk of losing money. That's a fundamental principle of investing that I needed to understand too. When I'm aiming for high returns, I must be willing to take high risks. When I'm putting my money into investment, I'm compensating the risk that I'm taking. Safe investments like government bonds from stable countries offer lower returns because the risk of losing money is minimal. In contrary, investing in stocks or emergency markets have a bigger potential of higher returns, but the risk is higher. So remember, the higher the potential return is, the higher the risk is, because it's my willingness to invest in uncertainties. So understanding and managing this balance of risk and returns is important for me, for every investor. That's why I mentioned diversifying, making sure you're having as much knowledge as you can gain, and aligning my investments with what I feel comfortable for, with my risk tolerance and financial goals to navigate this relationship. Last but not least, but also very important, please start investing. Start! It's not just theoretical, it's very practical. You can watch YouTube videos like this, you can read books, but you gotta gain practical experience. The earlier you start, the more you're going to benefit from. Trust me, the compound effect in that, and I'm going to make an extra video on it, is huge, because it makes a huge difference if you start investing now or in 10 years. There are thousands of dollars difference when I'm talking here. So if you have a lot to invest, a lot of money saved for example, to gain experience, start smaller. You can start investing already with as little as $25 a month. So choose a broker based on your research, start an investing plan, and get started. But that's not all. Reinvesting my gains was the most powerful tool that I learned, and I want to share it in this video too. To build wealth over time, the most benefit comes from the compound interest effect. This effect helps my wealth grow faster, but only if I reinvest my gains before I spend them. By reinvesting my profits, I can take advantage of that compound effect. This means that I'm earning returns not only on my original investments, from those $1,000 for example, but also accumulation over time, every time. Compounding can significantly increase your investment portfolio at the long run. That's why I said it makes a huge difference by starting now or wait too long. So even if the market is not very good right now, still start. When you're long-term investing, this is going to ease up over time. If you first want to get your finances in order before you start to invest, watch this video next. Other than that, it's only you who has the power to change your future to the better. Today, I hope this video was helpful and you clicked on the subscribe button and you learned one or two things about investing today. I regularly upload new videos like this about finance topics and self-development. So stay motivated, be productive. See you next time.